All right, let's be really straight. My Redbubble investment was a bad decision, and I could just leave it at that. But I think you will get some value out of the analysis of the decision. And a little spoiler, I actually haven't sold any shares in Redbubble. So here on my channel, I try to look at investing from a sensible angle. There is a lot of bad investing stuff online, and I'll let people like CoffeeZilla destroy those people. I love that channel. Anyway, here is my no bullshit approach to investing. So I know I'm not the only one out there who has had a stock investment look something like this. And since I bought it, that's nearly an 80% price fall, and yeah, that's pretty ugly. So the question is, was this a bad decision? Or was this just bad luck? Okay, I already said that it was a bad decision, but I could have made a great decision, yet the stock for whatever reason is down 80%. Is it possible that I made a really strong decision, but a bad outcome happened? Because if the stock was up 80%, would I feel like I made a good decision, or was it because I just got lucky? Now, I think there's a big difference. The result is not the same as the decision. The result doesn't define that decision. I could make a statistically great decision, but because life is life, there is a small, sometimes tiny chance that things just go wrong. Now, I've learned this from a book called Thinking in Bets. It's a great book if you want to make better decisions in life. Now, poker, for example, a great game that is a little like investing. We don't have all the information, like we don't have all the cards, but we have some information. We have our own cards, and we have the moves that other players make. We might have pocket aces and we bet appropriately and still get beaten. Statistically, it is unlikely, but it can happen. It was not a bad decision to play and lose money on that hand, it was just a bad outcome. And it is possible for an amateur poker player to beat expert poker players. It happens often, generally because of a few hands went their way. Betting on an offsuit 6-7 is statistically maybe a bad idea, but for the amateur who maybe got a bit emotional and didn't quite know their stats well enough, maybe they made the bet and ended up with just a great hand. So they aren't actually great poker players making amazing decisions. They just experienced a good outcome. Okay, now poker and investing, I guess, isn't the same, but it illustrates the point I'm trying to focus on, the decision, not the result. So let me take a look at my decision to invest in Redbubble. And to do that, I'm going to comment on my own video.
And this is how we're going to measure the performance over the next few years. See, we can follow artist revenue, marketplace revenue, gross profit margins, marketing spend, operating expenses, and EBITDA. So this slide here is actually going to be really helpful to keep for each annual report to see if the thesis stays on track.
Well, this is a good reminder that this slide, well, this is what they were thinking a year ago, a year and a half ago, and they haven't met any of these numbers, and they're not on track to hit any of these. It looks like maybe 2026, 2027 maybe is going to be closer to this. So that's probably a big reason why the stock price is getting punished, is because they're not keeping up with these guidance numbers.
Now, looking at the financials, we will find that the company has just inflected into profitability. 2020 was a boom year for Redbubble, as e-commerce businesses saw serious increases in usage. It is safe to assume that these growth rates won't be maintainable as the pandemic becomes less and less of an issue for retail. So net income has turned positive, revenue is averaging 43% per annum growth over the past 3 years, but again, we have to be careful of the year 2020 being an abnormality. Free cash flow has been growing impressively. This is great to see. Gross margins are now at 60%, which shows the competitive advantage is getting stronger.
Okay, this is funny to rewatch because I was right. That was the right thing to think of. The pandemic year I couldn't be confident in was going to maintain, but what I said was there was an inflection point that had turned into profitability. I was assuming that they would stay profitable, and they haven't, mostly because of management decisions, which I'll get to in a moment. But so far, I like the industry that they're in. I still like the industry, and I kind of still like the competitive position that they're in. Yeah, there's some big players in this space, but Redbubble have a pretty good little ecosystem. So far, so good.
Return on equity and return on invested capital are great growth metrics to see how the management team are growing the business through their investment ideas. So over 15% is good. So for return on equity and return on invested capital to both now be above 30%, the inflection point has happened for this business, and it's starting to make really good returns. Current debt levels are manageable, mostly because of that cash flow cycle I mentioned earlier. See, money comes in, they use this, then money goes out to the artists and manufacturers at the end of the month. It's like a float in insurance and makes the business very stable. Long-term debt levels, by the way, are practically zero, so there are no issues here. They also don't pay a dividend, which makes sense as they should be trying to grow and invest in that flywheel to strengthen that competitive advantage. A lot of people would think this is counterintuitive that I am happy about no dividend. But I would be very concerned if they were paying a dividend. That would be a red flag for me, but they aren't, so that's good. The next thing I want to see is how aligned is the management team with the shareholders. Now, the founder and director of the company, Martin Hosking, holds about 16% of the company. That is great. He has retired now as CEO, and the new CEO, Mike Izhnevsky, I don't know how to say that name, has only just started, and the board made him buy about $2 million of shares. Some of it with his own money and the rest is a loan from the business. The purpose was to align the CEO with the shareholders. Look, I'm okay with all this.
Okay, sorry for the change of shirt. It's too hot here. Okay, now this is a really important little clip that I just showed about management and how I was looking at management at the time. So the really bad decision that I've made here is I haven't done enough work on the management. I haven't done enough work on their ideas for the long term. I haven't interviewed them. I haven't got a feel for a lot of the soft things like the culture that they're trying to build into the company, how satisfied the employees are. I haven't looked at I looked at the incentives and whether they're aligned with shareholders, but that's not where it should stop. I really should have dug deeper in management, and that's what I'm not happy with at the moment. This is where I made the bad decision. So I'm happy with a lot of other things about this company, and I'm glad they're not still paying a dividend. I'm glad they've had to buy shares in the company, all that type of stuff. But I'm really trying to focus down for the future on just the best management team. And they gave me no signs in their annual reports that they are exceptional managers and exceptional. They're not outsiders from the book The Outsiders. They're not. When I look at companies that I've done a lot of work on recently, like Technion, SDI Group, TerraVest, even like Markel and Berkshire Hathaway, those are just exceptional people running good businesses, but just unbelievably good people. And I just didn't do the work on Redbubble from this point of view. And that's the problem. Now, since I made some errors in my decision, I could have got lucky and be up 80% or more, but the result has also not gone my way. That is understandable. The odds were probably 50-50 at best, hence why it was a bad decision. So should I just sell this and move on? Well, not so fast. Most people would think that it is best to just sell and put the money into a better company. But Redbubble actually isn't that bad of a company. It has some interesting things going for it. One thing they have is strong SEO rankings. Now, that's something that takes a long time to build up, and Google traffic rewards aged listings, and Redbubble do have pretty strong SEO. That's going to hold them instead for the future. So along with the SEO, website traffic has been growing, and the average duration on the site is really good. It's almost 5 minutes, and that's a lot of time. Comparing that to Etsy, well, Etsy is growing visitors too, plus around 6 minutes of duration on the website. And compare this with Amazon, and August has been actually a weaker for them, and the duration is around 7-minute range. So almost 5 minutes for a business, a fraction of the size of Etsy and Amazon. That is actually measuring up pretty well. If it was something like 1 minute or 2 minutes or something like that, then I actually would be concerned. But anyone spending on average 5 minutes over millions and millions of visitors to the site, it means they're browsing around the site, looking for certain things, spending time, they're engaged with the website, and that generally turns into purchases. Then turning to the balance sheet, and they have no debt and sitting on about $80 million in net cash. The market cap is actually only about it's actually 200 million or something at the moment. It might even be a little less. Sure, they have lost a little money last year by hiring too many people, but they said they don't need to hire any more people now for a year or two, and they can now tune up the business. So with the loss last year of 25 million, they have a few years before we have to worry about them raising debt or diluting shareholders. That is a bit of time to get more lean and more profitable. Plus, they are a very asset-light business as well. They don't need to hold the inventory, and they don't need to then write things off. So revenue is still coming in strong. Yes, it's down from the big pandemic year, but they are far better positioned than they were pre-pandemic. And if I look at what someone might acquire Redbubble for, say Etsy or someone like that, they would want the customers and the sellers. That is quite valuable. It is hard to build a platform that people use and this network effect that Redbubble has, the little ecosystem, and it's actually really valuable. I would estimate that an acquirer might be interested at maybe 1.5 to 2 times sales. The reason is that companies nowhere near as strong as this without a proven concept would get probably this valuation. I don't like price to sales ratios, but considering the value of their network and that ecosystem, I think it's worth about that for an acquirer. And then right now, the price to sales is actually a little under 0.4. So I think it only takes some good news that they have stabilized or even showing some growth. And I can see a fair value around 1.5 sales. Now that would be a 4x return from here, and that's about $3 a share. Now, considering the situation and how I now think about investing, I've done some calculations on my expected return from here. I'm factoring in my concerns towards management in this calculation. So, Redbubble possibilities in the next just 3 years. Based on the data that I have seen, the business has growing website traffic, so I think it is likely that they are not declining, but they're rather growing. I don't know what the market is going to think of this, but somewhere in these ranges I feel is probably the right outcome based on what I can see. So I think maybe a 20% chance of a double from here, maybe a 20% chance of a 3x, it's probably a 20% chance of a 4x, but there is like a 15% chance that I'm wrong and this all goes badly and management messed this thing right up and it goes to 0. And then there's also the chance of it getting cut in half again because of the same issues like bad management. Maybe they burn through that cash pile and have to dilute shareholders or something like that. And maybe there's a 10% chance of it just staying around about the same, the market just not reacting to any good news or anything like that. That's possible too. I don't think so, but I'm not really confident in any of these individually, but I think I'm skewing more towards it being likely that there's positive outcomes and unlikely that there's negative outcomes from here. Now, if I do the calculations on these expected returns, it gets to me to about a 1.95, maybe a 2x return from here in those 3 years. That's approximately 25% compound annual growth rate. So even though I'm not impressed with management, and I still think there is a chance it goes to 0, and even a 35% chance that things just underperform, it is pretty easy to see things being a bit more reasonable based on the information that I have. 25% compound annual growth rate after factoring in all these risks, I think, is actually a strong idea. If I was to sell now and put my money somewhere else, I would struggle to get above 20%. So I think the right decision is to not sell. Play the odds, and if the odds change, I'll recalculate the best I can. Now, this is far from perfect. There's a lot of judgment and experience and probably some bias going into this decision. I'm trying to stay emotionless, and I would sell if that compound annual growth rate was anything below, say, 15%, but it isn't, so I will not sell. I'll probably sell when this gets near the fair value though, so around that 1.5 times price to sales. And the reason I'd sell is because I have better management teams that I trust more and I think they have lower risk. Now, I do keep my buy prices and intrinsic values updated in my monthly e-magazine, and I use Interactive Brokers to do my investing, which is the safest of the brokers. Plus, don't forget about the Money Managers game that I'm running that you can join and see whether you have what it takes to manage money over a long period of time. All of these things are in the description if you want to find out more. Now, I hope you liked nerding out with me on the numbers and investing like this. I enjoyed rubbing my nose in my mistake here. I actually learned a lot from it. I'm not a masochist, but I'm just trying to learn to make fewer mistakes in the future. So subscribe if you haven't done so already, and I will see you next week.